The Holy Grail of investing is generating passive income, and today you're going to meet the godfather of lifestyle investing. His name is Justin Donald, and he's perfected a system of low-risk cash flow investing. And just 3 years ago, Justin quit his job as a division manager of Cutco, and since then, he's amassed tens of millions of dollars in net worth, all before his 40th birthday. Today, you're going to get exposed to a 10-step system that's enabled him to generate true wealth with low risk, almost instant passive earned income, a rapid return on his principal, and massive tax advantages without a job or a business he's stuck working in. Justin is going to share several case studies of how he finds, structures, and does deals like these and how you can do them too. So welcome the new Warren Buffett of the investment world, Justin Donald. How you doing?
Hey, Mike, I'm good. Thanks for having me.
All right. So I thought one of the ways that we'd get started today is maybe the best way is really for you to share how and where you got started and how you got to where you are today. Because I think a little backstory is always good for the audience.
Sure. Yeah. I spent many years as a division manager with Cutco and Vector, that organization. And during that time, I was investing in a few different avenues, mostly real estate related, but I was in a handful of different things. And eventually got to the point where I was able to move on from that organization and focus just on the investment world and things I wanted to get into.
All right. So one of the things that I've learned about you, and I've really learned a lot just since we started in talking, but you focus on cash flow investing. And what does that mean to you? What's your definition of it? And how's that fit into this whole concept of lifestyle investing?
Yeah, so cash flow investing is where you make some sort of return on your money in the present. So you make an investment, it provides some sort of cash flow today and with regular increments in the future. So a lot of people invest in companies where the payoff doesn't happen for a long time, if ever. You know, if the company makes it, then they might make a return at that point in time. I'd rather make the investment now and then get some sort of a return on that money in real time.
Okay. And then one of the other things that you have said to me that I felt was super profound, and I wrote it down, which is I wanted to get to a point where money becomes a game, not a need. So why don't you talk a little bit about your mindset? Because usually what most investors are worried about is just losing their money, but you've got a very unique way of thinking about investing.
Yeah. So, I mean, at a certain point, you need enough money to live, and that's really important. But when you can create some form of income that, you know, creates your standard of living and you're set there, well, everything above and beyond that ends up being money that you can invest. And so to me, you know, once you get to a point where you're not just trying to make money to survive, you're making enough that you can invest in other deals, it gets really fun. And once things get fun and your lifestyle income is covered, I think that you look at money differently, or at least I look at money differently. And it's really important. I think I put a lot more pressure on the return of an investment, or if I should go into this deal or that deal when it was my livelihood. I wanted to get to a point where it really didn't matter. If it performed great, if it didn't perform, you know, I'm still going to learn some great lessons from it. And that's really where it gets fun, you know, where it's more of a game than anything else. And I think I make a lot smarter decisions because that's the case. Yes. I'm less emotionally involved and invested in each specific deal.
Okay. And again, I think in my experience, it's fairly unusual, but you have a strategy. First of all, you're into more than 50 deals, which is, you know, quite a few, especially for someone your age. And the most important thing is how you structure them. So you have this high quality lifestyle, and you don't go to a job at all. So you've managed to have not only a mindset, but rules. And specifically, you've got what you've developed, the 10 commandments of lifestyle investing. So I thought one thing that would be super useful is for you to go through what those 10 are. And then we're going to break down, and I'm going to ask you some questions about some specific investments you've had, so our listeners or viewers or readers can understand how you apply those and think about deals, how you structure them, and how they can model your success, okay?
Sure.
Okay, so why don't you begin by just going through each one of them? And I know you drive from lifestyle. So again, I'd like you to talk a little bit about your specific perspective on lifestyle, because you've got a young family, you're married, and that's a super important part of your life. It's the most important part of your life.
It is. It is. It's, time is your most limited resource. So I wanted to get to a point where time wasn't producing the income that I lived my life with. But assets produce that. And that was really important to me. It was an important focus so that I could spend time with my family just the way I wanted to. I could do the activities I wanted to do because my income wasn't based on the time I'm spending doing anything. It was totally independent of me, and it happened while I was sleeping or doing, going on a vacation or whatever it might be. So that was kind of the whole framework of creating lifestyle investments, is that it had to work for me, it had to work for my lifestyle, and it had to be appealing that if I get in the deal, that it's not a huge requirement of my time. I'm not, I guess, at the demands as I have been in previous businesses that I've been part of or that I've started, where, there's a kind of like a sex appeal of being an entrepreneur and starting a business, but you can easily turn that into a job where you're locked into doing certain things all the time.
Yeah, I think that's something that I really am impressed with you, is you're not in a rush to be busy. And how you value your time, and even my engagement, my interactions with you have been just that. So let's look at number 2 on your list. Talk about how you manage risk.
Yeah, so with risk, I really want something that produces a good return, but if I can minimize risk in some way, shape, or form, I'm going to feel really good about that. That's going to be an incentive to me wanting to get into that deal. So how does that look? Well, to be able to collateralize assets against an investment in a case where you can get twice as much collateral as the actual amount of a loan or investment into a business. That makes me feel a lot more secure if things didn't go right, if we had to liquidate, that I'd be made whole as an investor.
Okay, good. And then the next one is one of your strategies is on looking at emerging markets. So talk a little bit about that, because I know our first example revolves around it. You've got a very neat way of selecting your deals and fitting within, again, it's both a mindset and a perspective.
Yeah, I want to pay attention to opportunities that are maybe not as mainstream. There are always emerging markets because something crazy happened in the financial markets, or because new innovations are happening with technology, or even just the way that companies reinvent themselves. And so I want to be on the cutting edge of what is new, what has life in the future, what's something that's blossoming right now that can be a standard for 10, 20, 30, 40 years. So that's kind of what I look for in those markets.
Good. And that's something else that I've noticed just in talking to you, is where, even the Warren Buffett style of value investing is definitely not returning what it used to. And the investments that you're involved in are producing, significant returns very, very quickly. So that gets us back to getting your principal back quickly, because part of cash flow investing is actually replacing your earned income. But talk a little bit about your principal and then creating cash flow, because that's the next step.
Sure. Yeah. So with principal, I want to get that back as fast as I can, because that gives me, if I can get it back within 1 to 2 years, I'm really happy. Most investments out there, it's generally a 5 to 10 year lockup on your money. And so if I can get it back in 1 to 2, maybe 3 years, I can feel real good about that, and I can turn it around and have it to reinvest in the next deal. So that's an attractive qualifier that I look for.
Excellent. And then your 5th step is about creating cash flow immediately, which again, fairly unusual in terms of being able to get all of these things. But why don't you talk a little bit about that? Like, how soon are the deals you're doing generating cash flow typically?
Well, I want it to cash flow day one. Most deals generally do, and it really depends on the deal structure. You could have something, for me, I find some deals that are monthly distributions, other deals are quarterly distributions. I like to kind of play in that realm a little bit more so than an annual distribution, or things that in theory pay out but might not if the assets aren't performing the way that you really want them to. So the goal is to get some sort of cash flow, at least on a quarterly basis, and ideally on a monthly basis.
Great. And then step 6, you call your income amplifier. What exactly is that? What are the income amplifiers?
So the income amplifier is kind of a unique way of looking at it. So obviously there's cash flow that I want to receive, but if I can get some extra kickers to that cash flow in terms of equity or a rev share, or, in some cases it's a sidecar agreement, with a direct investment.
For someone who's not a sophisticated investor, what's a sidecar agreement?
So often people will invest in funds, which are a collection of a bunch of different assets. And sometimes I might find an asset that I really like and want to have a direct investment into that asset. So being able to utilize a sidecar agreement where I get direct access to that investment and I can participate in some of the general partner economics of the deal makes it a lot more lucrative for me as an investor.
Okay. And then you have step 7 is cutting out the fat. And you're not a big fan of banks, the middlemen, or what I would consider traditional Wall Street, simply because of there's so many ways they get your money. So why don't you talk about that theory, that philosophy as well?
Yeah, so as much as I can find a deal that doesn't involve big financial institutions, I can feel good about that. I think there's a great way to utilize financial institutions, and we'll talk about that here in a moment, but I don't want to be forced into using them, and I don't want to be forced into deals that have to run through them. I don't want to pay a middleman a fee when I don't need to.
Mm-hmm. And then how about step 8, which is plussing the deal?
So for plussing the deal, there's a lot of different ways that you can plus the deal. Leverage would be one of them, getting into some form of real estate where you can put 15, 20, 25% down, but you still get the return as if you paid for it in cash. Your returns don't, they're not critical of how you come up with the total deposit for that investment. And so that is a great way of plussing the deal. But there are other ways to plus the deal, and the way that you structure deal terms, the way that you negotiate for more favorable opportunities as an investor. A lot of people think that the deal is what is presented to you, and I found that that's not the case. Generally, there's room for negotiation where you can get better terms and better perks, so that it's a lower risk, higher return opportunity.
Yeah, that's something I've learned as I've started investing, is how many investors don't ask for some kind of preferential treatment, or they find ways to add new value and end up getting a much better deal too. So everything's negotiable. So that brings us to number 9, which is using leverage to your advantage. So give us an idea what that looks like.
So, leverage to your advantage, again, I mean, it's some of what I talked about with utilizing financial institutions where you need them. One of my favorite ways to do that is to get non-recourse loans. So that way, if things don't go as planned and the investment fails, I'm not on the hook for whatever the loan amount is. That financial institution would just take the asset as its collateral. And in most cases, if I'm walking away from it, that's a good thing. They're not coming after any of my other assets. So that would be a great type of loan to focus on.
Okay. And another thing that, which is your 10th step, is every dollar of investment gets a return. And one thing I've learned about you is you've invested not only millions of dollars to build your portfolio of tens of millions, but you also educate, self-educate, and you've worked with a lot of people. So why don't you talk about your philosophy and how you maximize your investment and also your expenses too?
Sure. Well, I think there's a return on investment any way you slice a deal up. There's the actual return that you get from that investment, but at the same time, I'm utilizing financial or legal professionals or tax professionals. And so there is an investment there that is made, and I want to recapture the return on that investment. So a strict rule that I have with any professional I work with is that I'm not paying you to transact whatever it is that I need. I'm paying you to educate me how to do it in the future. I don't want it to be done. I want it to be explained to me, and I want to understand it. So for future deals, I can choose to utilize those resources, which I will, but it cuts down on the cost And it just helps me understand better which deals to go into and not go into because I have that education.
Right. So that ultimately means in future deals you're doing, your expenses with legal, attorneys, everything else is lower, but also you've built great rapport with all these professionals. So they start sending you deals because they see you more as an equal. And that's really helped because I know you're very much a relationship investor. So let's move on then to some of the deals, because I know one of the appealing things about setting this interview up with you was the fact that you've, as I said, done more than 50 deals. You've figured out ways to maximize these 10 commandments. So one of your favorite deals was a franchise business in the fitness world. It's a big name. Everyone would recognize who they are. We're not going to mention them specifically. I'm sure people can guess. But why don't you talk about how you applied the 10 commandments in this deal and how you structured it and what kind of returns it's providing as well? Because I know one of the most exciting things is right as we were preparing for the investment, you got a text message from the investors about your first month in business with this particular deal. So dive in and tell us what you got here.
Yeah, it was a very profitable month one, which is exciting. It's always nice when you cash flow the very first month, which is always my goal. Whether I receive that return on month one or whether it's a quarterly distribution, I still am looking for profitability inside of month one, ideally inside of day one. And so with this deal, it was just a really unique opportunity to get involved. I don't know much about franchises, or I should say I didn't know much about franchises. I've learned a lot since then, but it seemed like a really good play. I partnered with two operators that really knew what they were doing in that space. I'm not looking to be in any type of operational role anymore, so it made sense I could be a capital partner in this deal, not have to really sacrifice my time. I can do some advisory, which I enjoy doing, so it's more on my terms, but very lucrative terms as well. I have competent operators, and we were able to structure a deal where, you know, I came in with a little out-of-pocket capital with a loan into the business that is repaid with interest and on a pretty fast schedule to return it. So I should have that loan returned in about 1 to 2 years. With some additional kickers around it, but I also have 1/3 equity in that operation.
Great. So why don't we just go through each of the top 10 commandments and explain how this deal ended up being structured so other people can use this as a model.
Sure. Yeah. So as from the lifestyle standpoint, lifestyle investment, this protects my time. So first and foremost, I can let my money do the work. And my time is just complementary. It's secondary to anything else. And when I invest time, though, there's a large return on that investment of time. So the goal is to reap rewards of return just on capital or just on an asset. And if I have to invest my time, then I want it to be a lucrative turnaround. So that one was pretty easy. As far as reducing risk, when we structured this loan, I minimized the collateral that I was on the hook for. So even though I'm a 1/3 owner in this deal, I only am on the hook for 20% of the loan. So we used a bank, got an SBA loan. So it was a very small down payment, 14% down payment. And so having, in this case, it was a recourse loan. So that 20% is a real, I guess, quote unquote risk. But when you look at how quickly the business profits and how fast my loan is being paid back, it's really not a risk at all. It's a strong business model with a pretty high multiple upon an exit.
Okay. Now you also did, what's the invisible deals mean in this particular case?
Yeah, so in this one, it's just hard to get into this franchise. So this is a deal that most people wouldn't have access to. Luckily, through my network and some good connections, I was able to get this investment. But really, it wouldn't be available to 99% of the world, maybe even more.
Right, and I think again the the commandment we're really talking about is emerging markets. And you've already talked about getting your principal back quickly, which again is in, how long was that? It was 1 to 2 years, right?
1 to 2 years, yeah. And it's probably going to be closer to 1 year, but the whole structure was based on it being paid back within 2 years at a maximum.
All right. And then the best news of all, it's the cash flow. So you're focusing on building a cash flow business. So talk a little bit about that text message you got right before we started rolling the camera.
So I got a text message today that our very first monthly profit was at a little over $35,000. And that's really exciting for a business that opened less than a month ago. And it's nice because it's really set up to be a recurring revenue business where we just automatically charge credit cards, and that number should continue to grow every month.
Great. And then that brings us to your income amplifier, which most of the time when people hear about franchise deals, they're poor in terms of actual income. I know like Subways are notoriously bad at returning money. They're a bad investment because there's so many of them. You got in on a very popular franchise and you were able to get access to this deal. But what's the income amplifier in this particular case?
Well, the income amplifier is that, I'm acting as a bank or as a secondary mortgage, but I still have a large equity kicker at 1/3 the equity. So that's really attractive, a very fast repayment. And I'll talk about a few other perks, when we get to that, section of it. But on the exit, this is a very strong 5 to 8 times EBITDA type of exit. And so even if things were just going mediocre in the business, it's really easy to replace that income and not just replace it, to really get a good multiple on it.
Okay. And when do you think, how far into the future do you anticipate you'll be able to sell the business? So you'll get your money back, you'll get interest earned, you'll be able to share in the profits, and then the big exit, which is the big money.
Yeah. And so in this type of investment, the cash flow is pretty sizable. And so having some time getting those types of monthly returns is definitely warranted. But the exit could be 3 years from now, 5 years from now. This is where I like to pay attention to the trends. I like to see what private equity firms are doing, where they're investing their money, what type of multiples. Are there any other trends taking off? Is this a trend that feels like it's losing footage? So a lot of it's just timing. So for a strong cash flowing business, there's no need to sell it unless that multiple is so good that you'd sacrifice the cash flow. If the cash flow model is right, there's no desire to sell it unless someone makes you an offer you can't refuse.
Right on. Okay. So let's take a look at how you cut out the fat plus the deal, gain leverage, and maximize your other expenses into a bigger return.
Yeah, so in this one, we used a bank with a low down payment. I was able to put in some cash that it was a small percentage of the total loan, which was nice. And really, I had partners willing to do all the work. So I truly was the capital partner, which is very nice. And then for the part that I basically risked 20% of the collateral on the loan, they're paying me back in a dollar equivalent of what that is worth, even as that liability is paid down over time.
So what percentage are you charging the company interest on your money in this particular case? Just to give people an idea of what this could look like.
Yeah, so for that 20% collateral, it's about a 35% return. So it's pretty lucrative, but it's also really good for them. It very much is a win-win situation because without me having taken a portion of the collateral, I don't know that we would have gotten the loan. I know for a fact we wouldn't have gotten as good of deal terms.
Great. Okay. And then to the last one, step 10, which is every dollar getting a return. How have you leveraged outside counsel and your other investments to increase your capabilities?
Yeah, so this one's interesting because it was a business that I was less familiar with. So I learned a lot about franchises. I learned from legal experts on franchises. I learned a lot from my attorneys on this. So not only am I using my own attorney to structure the deal, but I also have to have an attorney dissect what the franchise agreement looks like so I can understand the terms there. Additionally, we did this build out from the ground up. So it was a full build. So I was able to learn how to do the entire construction aspect of building just an open box, which is fun and very interesting and something I can take for the future on any additional franchise projects or builds, even if it's outside of the franchise model.
Yeah, it's great. I think what I've learned just listening to you, how you organize this deal is not only can you take this to other franchise businesses, but now that you've got an in, there's an opportunity where you can go and structure and do pretty much the exact same deal with the same, if you can get your hands on another one of these franchisees and be able to put together multiple deals with a private equity firm. So that's super exciting. So let's move on to the next case study, which is, speaking of emerging markets, you actually got involved in a cannabis business. So that would definitely qualify as emerging markets. So talk a little bit about how this fits into your lifestyle philosophy with commandment number 1.
So again, I want a set it and forget it type of investment, if at all possible. So if I can just invest into something and just let the money do the work, that's ideal for me. I want smart professionals that are, handling all the logistics. I feel really good when I have my law firm kind of vet the deals and let me know, hey, you got a thumbs up here. We did some background research. Everything is as they say. And we like all the, people involved at the top at the executive level. So that really makes me feel good on a lifestyle first aspect.
Okay. And just for someone who's looking at this going, okay, great, but how do you get exposed to deals like this? So how did you find out about this and why cannabis? And do you really care? Because out of the 50 some deals, you're involved in lots and lots of different markets. So why don't you talk a little bit about your diversification and whether or not you care about the market or the type of investment?
Yeah, so this is a multifaceted question and answer because I do want to diversify my portfolio. So I do a lot of alternative investments and I want to create enough depth in that I have some hedge to, market cycles and everything. And when I find an emerging market that I like, cannabis being a great emerging market, but there's also a lot of risk to invest directly in a company. So there are a lot of ways to get exposure to it. Some people choose to do it through the stock market. Some people choose direct investment in a company. Some people choose to take like a senior debt position on companies. And so really it's figuring out what has the best risk reward scenario. For me, I want to be in a first position if anything should go wrong and things needed to be liquidated. I really want to be protected. I know the industry is going to continue to explode. I want a piece of it, but it has to be structured the right way.
Okay. So that leads us to risk reduction. How did you reduce your risk on this particular deal? What did that look like?
So in this one, working with a fund gives me exposure to a number of different deals. So that protects me. There's a lot of risk protection when you have multiple deals. So some can fail and the rest can succeed. And there's such a high margin of return on the ones that will succeed that it more than covers anything that doesn't. But additionally, the leverage, I should say the collateral that is in place for any of these investments is so great that if a company did have to liquidate, we'd be in an even better position as investors than if they had just made their regular payments. So I don't necessarily want a company to fail, but I feel really good when I'm in an investment that if they did, it would instantly 4x my return.
Okay. And that you've already explained the emerging market invisible deal, what cannabis is and how you got into this. So why don't you talk a little bit about how quickly you'll get your principal back and how you structured that?
Yeah, and so this deal's a little bit different because most funds, your money is locked up for 5 to 10 years. I think 7's pretty average and standard. But in this deal, this is one of the shortest lockups that I've seen. It's a 3-year hold. And the terms are also flexible. So if I had to get out in less than 3 years, I could. And I like that. I'm always looking for as much flexibility, liquidity as I can find. So the goal is to ride it out for that time frame. But what if some major crisis comes up? What if some even better investment opportunity comes up? I want to know that I have access to the capital. So this type of investment, for the fund structure that it is the most liquid of anything I've seen out there.
It's great. And so talk a little bit about the cash flow side of this business and how quickly it generates cash flow. And again, just as an example, what's the rate of return? How did you put this deal together that way?
So I love this one because most preferred returns, or preferred return is what you're going to make on your investment. It's generally paid out over a period of time, but it's an annualized return. And generally in real estates or funds, you're going to see a preferred return of 8%, maybe as high as 10%, maybe as low as 6%. I think your 6 to 10 range is most of what you see. I think, your 8% is kind of the sweet spot. But with this one, the preferred return is 13 to 14%. That's what's in their term sheet. But every single quarter that they've distributed, it's been above that. So they don't quote that they're going to do more. They quote what they're going to do for sure. But I like that they've returned a higher than anticipated preferred return every single quarter.
Okay. And then let's talk about the income amplifier. What kind of extra bonuses did you either work out or negotiate that go above and beyond the cash flow and the equity?
So in this one, because you're working with a lot of cannabis companies and banks can't lend to them, there are a lot of kickers that can be negotiated. So first and foremost, you can have a very high rate of return, and that's very normal in this space. That is just the price to get an investment. But in addition to that, you're able to negotiate equity in the company or different warrants. There are, a number of different opportunities depending on growth of the company. There are different metrics that can be thrown in based on a certain amount of growth and an extra kicker on return. So there's a lot that can be kind of added to sweeten the deal. And I like that the team I work with there are experts at sweetening the deal.
I love that. Okay. So then you obviously avoided the banks on this, but are there any other ways you cut out the fat?
Well, I like this because not only do we avoid the banks, but we can offer something that the banks can't offer, and we can offer it at a two times or 3 times typical interest, maybe even 4 times in some cases the typical interest that a bank would charge. So I'm a huge fan of it. And then at whatever point this industry is federally legal and the banks come into play, people can pay off their loans, and you're going to get paid back, but also there's prepayment penalties. So even though the interest may be really lucrative for a company that wants to go with a standard bank, we're going to get a huge exit on them prepaying the loan.
Great. And how did you plus the deal? Were there any other terms that you negotiated where you even made this sweeter than what was originally offered? Yeah.
So typically whenever I'm going to do a deal, because I will come in with a good amount of capital, or I'll come in with a number of people that I invest with, different investment groups, I'm able to negotiate preferential treatment, if you will, preferred returns for my group. Or for my portion of the investment. And so that may come off of management fees, that may come off of the carry, that may come off of, it may be an increase in preferred return. There's something that I always try to structure. It may be a decrease in the minimum to be able to invest in that deal, but I'm always trying to negotiate something to sweeten the pie for my group.
Okay. And then how about leverage? Was there any additional leverage, and how did that look?
So on this one, it's the loans are structured in a way. Every deal is different, but the team that underwrites it are foremost experts in the space of underwriting, and they're so just unique and strategic in the way that they kind of create their terms. So it's stuff that in many cases I've never seen before. In some cases I've never even contemplated doing, just very out of the box thinking. But because of the industry and because there's not, there's so much unknown with the Wild West. There's structures that aren't typical structures, and they're normal in this space. So much so that you can have a certain portion of the loan that goes to the cost of the loan that's paid up front, and it can be a large portion, a lot more than what you typically see, or different staggered steps where once a company hits a certain threshold, more money is released, but it's held until that period of time. Or if someone's going to pay off their loan, there's a prepayment penalty that is a very large prepayment penalty. So either one, it encourages them to not pay it off, or two, there's a good return even if they do pay it off. So really, the idea is coming up with a win-win scenario, no matter what a group decides to do, that the terms are so strong that you win in either scenario and you win well.
Great. And then how did I assume this was your first cannabis deal, but how else have you benefited from the education from going through this process and leverage the professionals that you normally would have to pay anyway?
Sure. Well, in this case, I'm getting to work hand in hand with the main underwriter for all the deals. So I've learned an immense amount of information and deal structuring and terms and properly collateralizing and even the legal docs to make sure that they are completely airtight, and that the collateral is perfected, as they say, and that no one can take a senior position. So in this particular investment, it's a senior debt fund. So you have the first lien position. So if anything does go wrong, you're in first position to get the proceeds from a liquidation. So that's what I want. I don't want anyone else in that. I want any other investor to be in a junior position to us. And so I've learned a lot about structuring deals based on that framework.
Great. Now let's move on into the third case study, which you got involved in another really interesting business, which was a massive clothing retailer, very well recognized brand, over 500 locations. And one of the challenges and the opportunities is, of course, retail's been going down, malls are disappearing, but you had a really, really unique opportunity here that, again, is invisible to almost anyone. So why don't you tell the story of how this worked and how you applied the 10 commandments to this particular deal?
Yeah, so this is an investment where, again, if you look at lifestyle first, it's one where I can just invest the money and not really have to do much after that. There's a team that's in place to really run it and to take the operations over, and they're skilled. They know what they're doing. This isn't the first time that they've done an investment like this. So I feel comfortable in their expertise. And then for me, I can just show up with a simple debt investment with some kickers on top of it.
Okay, so why don't you go through each of them? How do you reduce the risk on this particular deal?
So on this one, the company itself and all their assets were pledged as collateral against the loan. So I felt really good about that because the amount that I invested would far be covered if things didn't work out and this had to be liquidated.
Okay. And you've managed to get involved in one of the appeals of anyone who works with you as an advisor or as to be mentored by you is you've got exposure to lots and lots of deals. But why did you get access to this deal?
So this one was simply network. I knew the right person or people, it was one degree of separation or one contact through another person. And this is a deal where I believe that there were a total of 7 investors in this, and most people didn't even know it existed. If they knew it existed, they'd be in it. Not a single person that I'm aware of turned this investment down. It was just that good of an investment and that good of deal terms.
Okay. And this one also followed, at least based on what I've seen, fast principal. So how quickly are you getting your principal back? And then let's move on to the cash flow and how much you're earning on this particular deal.
Yeah, so this is a simple debt structure. It's a 1-year note that is giving 20% returns paid on a quarterly basis. So I'm getting a 20% interest payment each month. At 1 year, there's a balloon of my full principal. But then in addition to all that, I have an equity kicker. So for nothing more than the investment, which I get the return on that investment anyway, for nothing more than investing in the business, I also get equity in the business. And on this case, it was very favorable terms. It was 3% per $1 million. And this one is is unique. You know, if you look at that structure, not all deals is that going to make sense for, but because this is such a well-known brand and you know, there's over 50 years of branding with this company, it just made sense.
Right. And maybe just so to fill in the gaps for someone who's listening to this, just to be super clear, what happened is the company, they're shutting down all the retail, and you guys are effectively taking over all the online sales there's already money coming in.
That's correct.
So it's really like a no-lose situation with a lot of upside. So you already mentioned this, but in the context of the 10 Commandments, talk about the income kicker or the income amplifier, I guess that's the and how that works.
Yeah, I mean, really the income amplifier on this one is that whenever it does sell, if and when we decide to sell it, it's going to be a large return. That equity that we got for our debt investment could be worth a lot. So I like investing in big companies or companies that could be big upon that exit, you know, getting made full many times over.
Love that. And then talk a little bit about cutting out the fat in this particular deal and why you could cut out the fat.
Yeah, so we were able to avoid all lending institutions, which is nice. We were able to just raise money from a handful of investors and people that some of the investors have some expertise in this space as well, and the operators do. So it's a very familiar space that we believe we can grow pretty well, and the group of investors that are in it also have a pretty extensive network. So I feel like if there were any struggles, we've got the people to be able to cover it.
It's great. And one of the things that, just to go over some of the details here that are really attractive. So you go in, you make an investment, you get 20% interest paid monthly, plus all your money back in 1 year, or you can keep it in there. And you get equity, and it's a sizable amount of equity, so you're playing the long game. Is there any other way that you plus the deal on this particular, was there anything else that was sweet about this?
Yeah, I mean, even if there was nothing else, I think it's a pretty sweet deal, but we were able to make it even sweeter in the fact there are a couple of things. Number one is that we were able to buy $20 million worth of inventory for $6 million, but we did it all on consignment. So we don't have to come out of pocket for any of that $6 million. It's all as the product sells, which is as good of a deal as you can get. So I'm pretty happy.
And are they
with
warehousing it too, so you don't even have those expenses?
That is
unbelievable.
Correct. That is correct.
That's sweet.
And really just the overall deal in itself, we brokered a great sales price. So we were able to buy it well under market because of being in the right place at the right time, knowing movers and shakers, having people intimately connected in a space where they could be taken seriously. So again, this is network and kind of knowing the right people, but then also being in a position to make the investment on a very short timeline, a very short window of time.
It's great. And I think, again, what's important about this is we could sit here and go back and forth through 40 other deals and hear how you structured them, how you're getting your ROI. But I think what I really want to get to the core of is you being a triple threat. That's what you've been called before because your superpowers are unique, and that definitely translates into how you are mentoring and advising other people that you want to work with. So why don't you just talk about what your superpowers are and how you've gone about finding mentors to develop these skills and enhance them in such a short period of time, which I just want to repeat is your huge wealth burst has happened over a period of a few years. And because you've got these steadfast rules, these 10 commandments that you stick to, you really haven't lost any substantial money.
That's correct.
So why don't you talk a little bit about, first of all, the superpowers and why that is?
Well, part of it's just the network of people. So I've spent a lot of time connecting with the right people, and I think that's helpful, especially on some of these last deals. They wouldn't have happened if I hadn't had that network. But additionally, I am a student of anything and everything. So whatever I'm going to do, I want to know how to do it well. So I'm going to beg and plead with people to take me under their wing and teach me the ins and the outs of a business. And so for each business I've done, I've been able to find someone that has instructed me on just their wealth of knowledge on each specific asset class or style of investment. And that's been huge for me. You know, I'm not the type of person that's just coming up with these crazy ideas out of the blue. I'm very much a show me the plan type of guy, and I can copy it. I can mirror what you do. I can probably figure out some ways to improve it, but not even that until I can copy your framework.
It's great. And another thing that I wanted to ask you about, because again, we picked 3 very unique case studies, but I'm curious about, in your experience, what was the first investment that taught you some of the core principles that you're still using today? If you had to look at any one thing that just opened up your eyes to cash flow investing, lowering the risk, and developing your 10 commandments, I'm curious what that is.
Well, my first investment was, outside of like typical money market mutual funds, was an investment in a condo. And that seemed like a really good investment at the time. Unfortunately, I was buying at the peak of the market. Additionally, I ended up taking a home equity line against it at a certain point in time, which was also not a good move. And so I got to a point where I wanted to sell. I had a business opportunity. I wanted to move. I wanted to kind of transition businesses, and I was kind of stuck. And I couldn't sell because I would have been upside down by a large margin. And so I figured, I'll just turn it into a rental. I'll get some renters in there. And the problem with that is I didn't think about it ahead of time. And so I was negative cash flowing every single month for years and years and years because I just didn't think of simple things about market timing, and is something, too high of a price compared to market comps or compared to what they were, 5 years ago. Or let's say I just bought this as a straight up rental. Can I cash flow in the event that I did want to move out of it? So just some simple things like that really created a hard handful of lessons for me, but I'm glad it happened. At the time, it was really painful, but I learned a lot, and I'm a smarter investor today because of it.
And at the end of that, what did it cost you to get out of that deal? Like, how bad did it get?
So when I finally sold, I was $120,000 upside down. So I had to sell my property and come to the table with $120,000. That's a painful experience. And at that point in time, my cash flow is a lot different than it is today. So $120,000 back then, when that was, close to maybe even more than what I had in total savings, that was it was just a painful pill to swallow.
Okay. And then I remember the first time you and I met, we actually met in Fiji, and I sat you down. I was starting to ask you some questions, and you told me about an investment that I would have thought would have been smart, but that turned out to be one of your biggest and best investments. So why don't you just talk briefly about that one before I ask you a few more questions about some of the systems and principles you're using today?
Sure. Yeah, this one's going to sound a little crazy, even though it's a little more mainstream today than when I first started getting into it about 15 years ago. But it's mobile home park investing. And so I've always felt like the rental space is a good space. And since then, I've done all kinds of different investments in rentals. But this was my first real investment. And it started out with just investing in someone that was doing the operation. So I didn't own the asset, but I had a simple debt loan with collateral to cover anything should the investment not work out. And I got a 10% return, which was great. And I didn't have to do anything. I could just set it and forget it, if you will. And that was really nice. And the more I started thinking about it, the more I was like, man, that's a really nice return. This guy must be, and it was a friend of mine, he must be making a really good return also, because I don't think he'd pay me 100% of his return. And when I started digging and learning more about the business, I realized that he was paying me half. So I'm thinking, all right, well, 10% is really good, but what if I could make 20%? That sounds really awesome. I'm not making 20% anywhere else. This is really good. And so I started learning how to invest in mobile home parks to earn anywhere from 20% to, in my best case scenario, 105% return in year one, a cash on cash return. So however much cash I put into the deal, that percentage is the return I got just on that cash I put down.
That's great. That's huge. And I remember when I first heard that, I'm like, oh my God, this is the guy who I want to learn investing from, especially when I started hearing some of your philosophies. So I'm curious then, if you look back at what you've invested in mentorship, your education, I know you belong to a lot of clubs where you get access to any deals. But if you think about when you began this journey, what do you think you've invested in mentorship, your education and training so far, just to get to the point where you know what you know now, and you're at this point where you've amassed tens of millions in wealth?
Sure. Well, it's easily hundreds of thousands of dollars. It's probably crossing the $1 million threshold. But yeah, it's a very active role in my investment education. This is one thing where you always hear people say, invest in your business first. Well, I feel like I want to invest in myself first, in my financial education, before I do anything else. So that way, when I invest in my business, I'm investing it in the right area.
Great. So that translates into, now that you've been doing what you've been doing, you've started taking people under your wing as an advisor and as a mentor. So why don't you talk a little bit about who you're looking for to take in and work with, because you're providing deals, structures, the frameworks, you're helping people negotiate better terms, or you're already bringing pre-negotiated deals that you've already vetted and in some cases already invested in, which even lowers the risk more. So why don't you talk a little bit about who's a right fit to actually work with you, so you can teach and mentor them some of the strategies and also expose them to all these hidden gems that you've had access to as well.
Well, I think first and foremost, it's finding people that want to learn about investing or just want their money to be put to work so they don't have to spend the time doing it. To learn, I guess, good deals and have a source of vetting so they don't have to spend their active time and energy doing it. I can do that for them. But it really breaks down into a couple of different groups. I think if you really want to get serious with something like this, you probably need about $500,000 to be able to use in investments and, allocate and diversify appropriately. So that would be, probably ideal. But we also have a club level version as well for people that aren't sitting on $500,000 to be able to invest.
Okay. And that would be someone who wants to work in a group environment where it's kind of mastermind style, and then you're teaching the principles, but you're also creating networks and connections. How does that work?
Yeah. And so it is very much mastermind style, a great network of people. So even if someone, quote unquote, didn't find a great deal, which is hard to believe, or something they felt like they could pull the trigger on, just the network of people alone is worth being around. It's just very smart, successful, hardworking, and educated people. It's also people that are looking to avoid costly mistakes. So I can share, a lot of the legal that I've gone through, both good and bad, that, in itself is worth more than the price of admission.
Okay, great. And I know one of the things that you've put together is a document with all of your 10 commandments in it that people can go to your website, download those. They can also learn more. They can apply for the group, working with you directly, or folks who have businesses and they're looking for investments and access to a network like yours, just to get some information. So that's at justindonald.com. Is there anything else that you'd like to add before we wrap up?
Yeah, well, I think that I'm really looking for people that want some sort of a role in investing. They want to be a better investor. They want better returns for their income, or they have a business that's kicking off a good return and they don't know what to do with that income, or they have a business that they're looking to grow with the opportunity for that, but don't know who to necessarily partner with or consult with. I mean, any of those would be a really good fit for what I'm looking to do.
Right. And just so we've said this, you are providing training And that is really what this is. It's a training and education system. So you're not providing, just so we're safe here with regulation and that kind of thing. So,
that's correct.
okay.
Yeah. Curating a great network of people, providing philosophies and teaching lessons of what I've done that's worked, what I haven't done or what I have done that hasn't worked. So really just trying to make sure that people are taking a holistic approach to the way that they invest.
All right, fantastic. So to learn more, again, all you have to do is head on over to justindonald.com. There you can get the download. You can learn more about you, get more background, and of course, access to some more tools and resources. So, well, my friend, this has been fantastic. Thank you very much.
Thanks a lot. This was a lot of fun.
Yep,
thanks for having me on, Mike.
Thank you. And for you, thanks so much for watching. And make sure you leave some comments below about this. And again, visit justindonald.com. Thanks again for watching.